100% as before. So that means we see the bank acquire more room for the LDR ratio in providing the lending for the economy. Regarding to the growth scenario for the second half of the year, so the government guiding for nearly 12% growth in the second half from the first result in the first half of the year is 8.2% growth. In other, for the full year result, 10%. Regarding to the key driver for the growth, so the government also guiding for 34 province and city with a higher growth compared to the first half of the year, especially for Ho Chi Minh City and Hanoi, together accounting for about 35% of the total national gross domestic product. The second key regulation recently implemented is the decision number 1119. So according to the decision 1119, we see some of the key area that the government guiding for significant change compared to the last 5-year term. The first thing is they're trying to cutting the current expenditure spending from 62% to just 51% in the next 5 years. And at the same time, they're trying to accelerating the investment spending from 28% to 40%. Meanwhile, they continue to keep the prudential ratio for public debt ceiling, government debt ceiling, and external debt ceiling at 60% and 50% respectively. And in addition to that, decision 1119 also trying to guiding for the SOE sector to have 50 large enterprise included in the top 500 in Southeast Asia region and 1 to 3 included in the top 500 in the world. The second part I want to talk, as I mentioned, regarding to the current situation of the funding structure of Vietnam. In the first half of the year, the total capital mobilizing from the economy was estimated at 1.9 billion Vietnam dong, including 114 trillion raising from the equity market, accounting for the 6%. Meanwhile, the private corporate bond issuance at 8% and public bond at 1%, and the rest and the government bond issuance at 10%, and the rest 75% is coming from the new lending from the banking sector, showing that the funding structure of Vietnam market is still very heavily reliant on the banking sector. The total amount raised for the investment, disbursed in the investment in the first half of the year were 1.8 billion Vietnam dong, including 28% coming from the state sector, 54% coming from the private sector, and 18% coming from the FDI sector. Under the resolution number 25 of the National Assembly of Vietnam. So Vietnam targeting 40% of the total social investment by the next 5 years on average. Among that, the contribution from the FDI sector to the total social investment aiming at 25% by the year 2045. Regarding to the FDI landscape in the first half, it was very optimistic, with disbursement rising about 11.2% over the same period last year, and marking the highest level of the FDI disbursement in the last 5 years. According to the survey from the FDI investor from the Eurocharm, we see 8 criteria remaining the key challenge for the FDI business, of which the most challenging area still the administrative and procedure paperwork. Second is regarding to the regulation, and third regarding to the tax administration. Fourth regarding to the custom procedure, and fifth regarding to the labor shortage. Other area Vietnam need to improve also regarding to the visa and working permit, the overlapping of the government requirement. Surprisingly, the infrastructure and energy constraint is among the least challenge for the FDI investor, showing the government right direction of improving the infrastructure of Vietnam in the last few years. Regarding for the corporate bond market, so in the first half of the year, the outstanding corporate bond was account to about 12% of last year's GDP, with the outstanding value still dominated by the banking sector accounting for 46%, and the real estate developer accounting for 32%. Meanwhile, other sector, including the manufacturing activity, only accounting for 22%. According to the decision number 1726 of the government of the Prime Minister in 2023, so the Vietnam targeting the outstanding corporate bond to reach 25% of GDP in the next 5 years. So we see it's still a very big gap for fulfilling this target. Regarding to the equity market performance in the first half of the year, the market capitalization continued to increase to about 82% of GDP in 2025, compared to last year 79%. Meanwhile, the daily liquidity still maintained at the fourth highest level in Southeast Asia, at about $1 billion per section. Despite that, the foreign investor continue to be the net seller on the Ho Chi Minh Stock Exchange for a fourth consecutive year, with the year-to-date selling of $3 billion, accounting for 62% of the net selling in 2025. And cumulatively, in the last 4 years, the foreign investor already sold Vietnam $12.4 billion. That's one positive news is in terms of the market capitalization. The Ho Chi Minh Stock Exchange right now surpassed the Philippine and Indonesian stock market in terms of the share GDP. The government aiming for the stock market to account for 120% of GDP by the year 2028. Regarding to the equity market outlook towards the year 2030, so one of the important thing is regarding to the MSCI upgrade. We already know the procedure with the FTSE upgrade. Passive inflow are estimated by us to have by more than $1 billion in 4 phases in September, March, June, and September next year, respectively. Meanwhile, the resolution number 10 on FDI, the government set a target for Vietnam to be upgraded by MSCI before 2030. We see there's a lot of challenging for the Vietnam stock market to be included in the MSCI emerging market, as we highlight in some of the key criteria in the table on the slide. But basically, we see some of the positive movement, especially regarding to the introduction of the global broker trading model that allowing for the foreign investor to access the market without opening a domestic trading account, and also the establishment of the CCP mechanism to be commenced in the first quarter of 2027, and the continued progress with the implementation of the English language disclosure requirement. At the same time, the government trying to easing the restriction across a number of sectors for the FOL for the foreign investor, and the MSCI will continue to monitor this implementation in going forward. Regarding to the foreign exchange market, the market remained very stable in the first half of the year, with Vietnam đồng only declined 0.1% in the first half, and making it the second most stable currency among Vietnam key trading partner. That is very encouraging in the situation in our neighbor market. The depreciation pressure for some currency like in Philippines, Indonesia, in Europe, in Japan, and making the central bank have to raise the policy rate in the first half of the year. But Vietnam continue to maintain the policy rate stable in order to support for the economic growth. Despite that, the trend of Vietnam đồng depreciation continue with a cumulative 14.3% since 2022, and making it one of the three weakest performing currency among the peer group, only better than Korea won and Japan yen. The Central Bank of Vietnam also released the first quarter balance of payment, which deteriorating compared to the fourth quarter of last year, with the overall balance deficit 1 billion percent of the surplus of 2.4 billion. However, a notable bright spot was the sharp decline in the net area emission. But the interest rate remained elevated in the first half of the year, with both deposit and lending rate continue to edge higher, suggesting that the liquidity condition in the banking sector remain very tight. At the same time, the government bond yield also trending higher, but remain lower than 4.5% across maturity in both the primary and the secondary market. In the primary market, the average government bond issuance rose to 4.1%, up about 0.3 percentage point from the 2025 average. And at the same time, the corporate bond yield issuance for bank and real estate developer reached the highest level in a decade. This slide shows our talk on the banking system liquidity from the most macro perspective. First, we observe that the share of the credit funded by the deposit declining to 86% in the first quarter of this year, according to official data from the Central Bank of Vietnam. So that driving the liquidity demand in the interbank market to a record high. The average daily trading volume in the interbank market reached about 870 trillion in the first half of the year. Meanwhile, the interbank overnight rate also climbed to the highest ever level in a decade of 5.7% on average. To support the banking system liquidity, the Central Bank of Vietnam has suspended the bill issuance in late July last year. And according to our database, at the end of June, the Central Bank of Vietnam has injected around 245 trillion of net liquidity through the open market operation at the interest rate at 4.5%. The deposit to credit ratio has declined, we think because the credit growth consistently outpacing the deposit growth, with the credit expanding by average of 15% in the last 5 years and accelerating to 19% last year. At the same time, the currency in circulation outside the banking system surged by 29% in 2025, based on the data from the Central Bank of Vietnam and our calculation. In 2025, the SJC domestic gold price rising about 82%, broadly checking the global gold price. And we think that was one of the key factors contributing to the sharp increase in the currency in circulation outside the banking sector. One good news is in the first half of the year, the gold price domestically declined by 4%. So we hope for a kind of improvement in terms of the deposit in coming months. Regarding to the credit demand for the large-scale project for the private sector, but funding for the public and national mega project through 2033. So for 2026, the Central Bank of Vietnam has set a credit-wide system growth of 15% with flexibility in adjustment, whether upward or downward, based on the actual economic situation. Excluding the loan for 18 last project as we highlight here. So that would, from the credit quota, from the 15% credit quota, so that would increase about 1.1 additional percentage point for the credit capacity in this year. And the credit financing for the 18 project estimated at about $29 billion, with around 85% to be implemented during the 2026 and 2028 period. This is the capital market development strategy toward 2030 by some key criteria. So the government bond market, the government trying to raising to 33% of GDP from 22% currently. For the corporate bond to 25% from 12% currently, and for the stock market to 122% by the year 2028, 2 years earlier than the timeline set in the decision 1726 of the government. This is the macroeconomic and financial service indicator. We see public debt and government debt to GDP as well as the external debt to GDP still much lower than the cap level for the next 5 years. However, the credit to GDP is estimated at around 145% last year, and this is 3 times higher than the median level, 52% among the country rated BB, that is the same rating with Vietnam by Fitch Rating, showing this is a key challenge for Vietnam to be upgraded by Fitch Rating for become the investable grade. Vietnam aiming for achieve the investment grade sovereign rating by 2030 according to the resolution number 109. The current Fitch Rating for Vietnam is B+. That means only 1 notch below the investment grade with a stable outlook. The Fitch Rating welcome Vietnam for very strong economic growth prospect as well as very relatively favorable fiscal space, as we mentioned in the previous slide. However, the high reliance on the credit growth, the banking sector risk, and the potential contingent liability remain the key constraint preventing them to upgrade Vietnam to investment grade of BBB. So here is the report from the Fitch that I highlight. This is the latest report in June, I think. So
đối với nhà tư cá nhân mà bây giờ mà đi theo dõi
RM model indicating Vietnam is already classified as BBB, but they downgrade Vietnam 2 notch to BB+ from the macroeconomic adjustment and from the public finance adjustment, as we mentioned. For the macroeconomic adjustment, because the high reliance on the credit-driven growth and the limited data transparency and weak policy consistency. And for the public finance, because of the contingent liability,
tôi lấy ví dụ ngay cả chúng ta nhìn thấy
and
là trong
banking sector and SOE, despite the current low public debt level. They also mentioned some potential for upgrade factor and some potential for downgrade factor. You can read the slide later. This is the last slide I want to mention before I hand over to Ms. Ha for the next section. This is the financial strategy for Vietnam.
Thì chúng ta thấy rất nhiều lời kêu gọi là hạ lãi suất, hạ dòng lãi suất. Thế nhưng thực tế cho đến nay chúng ta nhìn thấy nó rất đâu có hạ đâu. Vì nó là
have a growth model based on investment driven together with the export driven like in the past. According to the IMF, Vietnam grow in the next 5 years still the highest economic growth rate in Southeast Asia at average of 6.4%, but it's still much lower than the National Assembly target of 10%. Vietnam also become the upper middle income country based on the World Bank threshold that the GNI Vietnam reaching nearly $5,000 in 2025, above the threshold of $4,600. So when we're looking at the ambition of Vietnam to grow from this $5,000 per capita last year, according to the data from GSO, we see that no countries in history has sustained the average annual growth rate of 10% for the next consecutive 15 years, starting from the 5,000 level. The highest growth suggested in the past were coming from Singapore at 8.3%, followed by South Korea at 7.7%, and Taiwan and China at 6.7%. However, we see a kind of similarity between Vietnam and China the last 15 years ago in terms of the social investment to GDP. So the China social investment to GDP declined from 47% to 40% during the last 15 years period, 2010 and 2024. This is quite comparable with Vietnam current income level. So meaning Vietnam have a room to follow the China model for growth. Especially the National Assembly, they set the target for Vietnam I-Core to decline to an average of 4.5% to 4.8% in the next 5 years. Based on our estimate, the I-Core Vietnam last year stood at 4.3%. So that means it is below the target of the government. However, for the last 5 years, it's still above at 6.7%. So the key thing is we need the social investment to rise. The aiming for 40% is on the right track, but we also to monitor the effectiveness of the investment. With that, I would like to conclude my slide on the update on Vietnam regulation and the funding status. Thank you.
Yeah, thank you, Dr. Long, for your comprehensive presentations and framing the structural reality of this growth target so clearly. So in short, despite external challenges and domestic issues like high liquidities and elevated interest rates, Vietnam is still in the good shape to achieve the strong GDP growth in the coming years versus regional peers. And this is supported by more room of the fiscal policy expansions and also with the strategic focus on the infrastructure projects. So client and investors, if you have any questions, especially for the Dr. Long macro outlook, please hold tight and drop them in the chat box. We will address them shortly during the Q&A sections. And next, we will shift our focus to the executions and capital. I am delighted to hand over the floor to Ms. Ha, our head of research. She will diving into the latest regulatory updates and exploring exactly how the countries and banking system to plan to fund this new eras of Vietnamese economic growth. Over to you, Chị Ha. Thank you.
Thank you, Han. Can you please grant me? Okay, I can share the slide.
Yeah, it's good to go, Chị.
Okay. So good afternoon. So today my presentation will focus on how Vietnam's banking policy is evolving to support the next investment cycle. So I will focus on 3 major questions. Why these measures are needed, how much additional capacity they may create, and which banks are best positioned to benefit. So this slide is a bit overlap with Dr. Long, but from our banking perspective, I just want to point out that Vietnam's next growth cycle will require a substantial increase in investment. The government plan implies that private investment will need to more than double compared with the previous 5-year period. Private capital is also expected to represent the largest component of total investment. This reflects a broader change in the development model, with private sector groups are taking a larger role in infrastructure, including airports, ports, metro system, expressways, and railways. These, the projects shown on the right illustrate the scale of the funding requirement. And several projects individually require billions of US dollars, and most will need long-term financing rather than just short-term working capital. So the implication for banks is a sharp increase
Đến năm 2030 có lẽ đường bộ và đường cao tốc này chúng ta đã hòm hòm và chúng ta sẽ bắt đầu vào một thập niên mới, đó là thập niên về phát triển về mặt đường sắt. Trong suốt khoảng 5 đến 6 thập niên vừa qua, chúng ta không xây dựng được thêm 1 km đường sắt nào. Nhưng bắt đầu từ năm 2025 thì chúng ta đã bắt đầu đặt đường ray cho những
as you can see that deposit mobilization has actually recently slightly improved with monthly deposit inflows strengthened since late March, as you can see here. And this has helped slow the deterioration in the credit deposit gap. You can see it is kind of flat from March until June. However, the system is still operating with a limited liquidity headroom. The loan to deposit ratio has risen to around 115% since March until now, while credit continues to grow faster than deposit. Competition for funding also remains intense, as reflected in elevated effective deposit rates and also periodic volatility in overnight interbank rates. In this chart, we have the two bars here showing the kind of the highest level of interest rate we've seen in the previous peak in late 2022, early 2023, at around 11%, and the current time, then the 12-month deposit rate also like ranging around like 8% for state-owned commercial banks and 9% at private banks. So it has increased around 100 to 200 basis point compared to the the level seen like in the first half last year. However, it is still roughly 150 to 200 basis point lower than the previous peak. So this lower right chart here is the key one. The cumulative gap between credit creation and deposit mobilization remains substantial. This means banks are being asked to finance a larger investment cycle without a corresponding increase in stable funding. So the authorities therefore need to create targeted lending capacity while avoiding the risk associated with broad liquidity injection. So this timeline shows how the regulatory emphasis has changed. At the beginning of the year, the focus was more on balance sheet discipline. The State Bank set a 15% credit system credit growth target, also imposed tighter first quarter credit control, and also restricted real estate credit growth. The prudential direction was also becoming more conservative through the proposed Basel III framework. From May onward, the authorities began introducing targeted adjustment. These include the recognition of state treasury term deposit in the regulatory LDR loan to deposit ratio, a higher cap on short-term funding used for medium and long-term lending, exemption for selected real estate segment, and credit quota exemption for designated infrastructure projects. So the common objective is to remove the bottlenecks for priority lending without relaxing standards across the entire system. So here I just want to highlight the key easing policy in place. So the policy package has four components, as we briefly discussed in the previous slide. Each address a different constraint. So first, quota exemption, increase lending headroom for designated infrastructure projects, also for social housing and industrial parks. Second, the higher short-term funding for medium and long-term lending ratio allow banks to support more medium and long-term lending. Third, the inclusion of state treasury term deposit in the regulatory deposit base provide additional flexibility in managing the loans to deposit ratio. And fourth, the Ministry of Finance may be permitted to place a larger share of state treasury funds with commercial banks. So these measures address credit capacity, maturity constraints, regulatory liquidity, and the actual funding supply. They are complementary, but their impact vary by bank. Participation in eligible projects, current liquidity ratios, access to treasury deposit, and internal risk limit will determine how much benefit each bank receives. The near-term easing measures should not be interpreted as reversal of the long-term prudential agenda. Here in this slide, we just highlight the draft Basel III framework. This framework remains important, although implementation may be delayed or revised. So just with the current draft, the proposed framework would include an 85% credit to funding cap, a phased implementation of the liquidity coverage ratio, LCR, and net stable funding ratio, NSFR, and also propose a minimum leverage ratio, LEV, of 3%. So over time, these requirements will place a greater value on stable customer funding, high quality liquid asset, and disciplined balance sheet growth. So this creates an important distinction for investors. So in the near term, policy may favor banks with access to priority projects. However, over the long term, banks with strong retail and SME deposit franchise should be better positioned to comply with tighter liquidity standards. So this slide provides a bit more detail on the composition and recent growth of real estate lending. So the first point is that credit to real estate developers expanded very rapidly between 2023 and 2025. So over this period, developer credit grew at more than twice the pace of overall system credit. So this helps explain why the State Bank introduced tighter controls on real estate lending for 2026. However, the policy treatment is not uniform across all real estate subsegments. So industrial park and social housing have long been priority areas for the government. Industrial park support FDI inflows and manufacturing expansion, while social housing is intended to address the shortage of affordable housing in Vietnam. Despite this policy importance, both segments still account for only a small share of total loans to real estate developers and projects, with industrial parks represent around 6%, while social housing accounts for less than 1%. This means that the recent extensions are targeted rather than broad-based, and they encourage credit to priority subsectors, but are unlikely by themselves to materially expand total real estate lending. The more meaningful increase in credit headroom actually come from the separate exemption granted to major infrastructure projects. So the exemption for the 18 major infrastructure projects is quite significant. These projects cover 4 main clusters: APEC-related development, public-private partnership projects, metro and railway lines, and Gia Binh International Airport. Total funding needs are estimated at around 752 trillion Vietnam dong. equivalent to around 29-30 billion US dollar. And importantly, around 85 of the required funding is expected during the first 3 years from 2026 to 2028. So based on our estimate, excluding these projects from the current credit quota could add approximately 1.13 percentage points to 2026 system credit growth headroom. And the impact will be concentrated among banks that have relationship with the relevant sponsor, project sponsor, and also the capacity to arrange large and long-term facilities. So this slide, I want to mention more on the liquidity support. So policy support is being coordinated through complementary channels to strengthen the banking system capacity to fund infrastructure projects, while also ease liquidity pressure. So the first channel is the increase in short-term funding ratio cap, or you can call it SML cap, from 30 to 40%. So this gives bank greater flexibility to use short-term funding for medium and long-term lending, which is particularly relevant for infrastructure projects with long construction and repayment periods. Based on our estimate, the higher cap could theoretically unlock around 1.3 quadrillion Vietnam dong in additional medium and long-term lending capacity. However, this regulatory capacity, rather than a forecast or actual loan growth, utilization will still depending on capital funding availability, project quality, and each bank's internal risk limit. The second channel is the greater flexibility for state treasury placement, with the Ministry of Finance may be authorized to determine the ceiling for treasury deposit placed with commercial banks, potentially including both state-owned and private banks. And this could provide direct funding support to participating lenders and help relieve system liquidity constraint. So taken together, the two measures address both sides of the equation. The SML adjustment expands banks' capacity to lend long-term, while treasury placement provide additional funding to support that lending. So the next slide will look a bit more closely at the potential scale and distribution of state treasury liquidity support. So the total treasury balance we estimated is around 1.5 quadrillion Vietnam dong, and it is held mainly at the State Bank and the three large state-owned banks, including Vietcombank, BIDV, and Vietinbank. So further liquidity and LDR relief remain available through two channels that we mentioned earlier. So, assuming a theoretical 100% cap for both treasury placement in the banking system and also 100% of their inclusion in the regulatory deposit base. So we estimate that if both ratio, right, both cap is 100%, then the banking system will have additional 750 trillion dong additional deposit, which equivalent to around 4.3% of the current customer deposit level. So that is the theory. However, we think that this is hardly the case. Actually, sometimes the additional, maybe still the inclusion of the state treasury deposit in the deposit base are likely to stay less than 50% in our opinion, as well as the amount of state treasury deposit to place in the commercial banks, because because for the state treasury, because it's also depending on the public investment and the plan for disbursement of these funds. So it's 100%. It's just in theory. It's gonna be hardly the case. And the impact will also depend on how these deposits are distributed. If placement remain concentrated among state-owned banks, then the state-owned bank will capture most of the benefit, and a broader allocation could extend the support to selected private banks involved in priority infrastructure projects. And also, we also want to point out that the state banks has also recently indicated that refinancing could be considered for key national projects, although treasury placement appear to be the more straightforward liquidity support mechanism. So our interest rate outlook. So our base case is for interest rate to remain broadly stable. Improving deposit growth and regulatory liquidity support should reduce the risk of further sharp increase in funding costs. However, the credit deposit gap remains wide and competition for customer deposits still very intense. So these forces are likely to offset each other. In a more favorable scenario, substantial treasury placement or other liquidity support could allow deposit and interbank rates to decline modestly over the next 1 to 2 quarters. So just, as an overall conclusion here, we do not expect aggressive easing, and the more likely outcome is stabilization with selective relief for banks receiving additional liquidity. The benefits are unlikely to be evenly distributed across the sector, as we already, mentioned. The strongest near-term beneficiary should be banks that combine 3 attributes: access to designated projects, sufficient balance sheet capacity, and a credible funding channel. So we list here, selected banks like Techcombank and NDB. They have direct ties with developers in the 18 infrastructure projects. Banks who have infrastructure focus, we have state-owned commercial banks and MP Bank. We also have other banks here who have strong ties with developers in general. That include SDB, LPB, VPB, and HD Bank. However, the potential benefits here include faster credit growth, improve fee income from project financing, stronger market sentiment, and potentially, the access to treasury-related liquidity. However, we want to highlight that the principal risk is underwriting quality. Long duration infrastructure projects may face delays, cost overruns, legal complications, or uncertain cash flow timing. So this, overall policies improves the ability to lend, but investment performance will still depending on how selectively that capacity is used by each bank. So I have this last slide here is about the coverage comparables. So the sector right now trading at 1.43 times of 2026 price to book and 9.3 times earnings, with an average return on equity of around 17% and EPS growth almost 14%. We don't have our topics here in this slide because, as I mentioned before, our preferred framework is, for us to look at the assets, to assess each banks on different dimensions. their policy assets, their funding strengths, and the valuation. I would leave, I would end my part here and leave the room and time for Q&A.
Thank you, chị Hà, for very highly informative presentations on the banking sectors and underlying the credit dynamics. Your insights on the latest monetary selected easing policy clearly show how the system is shifting to support the Vietnam new investment cycles. So now we open the floor for the Q&A sections, and we want to make this interactive as possible. So you have two ways to participate in the Q&A section. Please use the raise hand features, and we will unmute you so you can direct your question to Dr. Long and Ms. Hà yourself, or you can type your question directly into the chat. So I will read them out to our speaker one by one. So let's address our first questions. This is for Dr. Long. The clients want to ask your outlook on Vietnam POP for 2026, given the widened trade surplus year to date?
Yes. Thank you. Regarding to the balance of payment, so we know the first quarter result is a deficit of about $1 billion. According to the latest data from the government until the end of June, so they mentioned the foreign exchange reserve of Vietnam at around $87 billion. So that means about $4 billion higher than the last year number. So that means probably there's about a new $3 billion of the FX reserve accumulation in the second quarter of the year, meaning that the balance of payment likely to turn to surplus again in the second quarter of the year, according to their forecast. This is, if it is true, it is quite surprising to us, given you mentioned about the deficit in good of about $16 to $17 billion in the first half of the year. If that happens, so I think from our assumption is for the full year, we continue to see a very small amount current account deficit because of the trade deficit, not likely to improve in coming period. However, there should be a big improvement in terms of the financial account, including we see the number of the FDI commitment and disbursement is very positive. And in addition to that, we see the declining in terms of the error and omission. So overall, for the balance of payment in 2026, we expect that the overall balance payment still in positive position for this year. Currently, we already revised up our forecast for the FX reserve number of Vietnam for this year. I think to around 87 to 88 billion US dollar. So that's reflecting our expectation of the overall balance payment surplus this year. Thank you.
Yeah, thanks, Anh Long, for your very detailed answers. So the next question is as interest rate have been increasing, how would that impact other areas such as manufacturing and consumption in your view? And what is the difference in bank lending rate to the real estate versus the manufacturing and consumption? Thank you. I think so. For the first, it should be Dr. Long, and then if Ms. Hà have any elaborate, so we can extend the.
We only have the. I think we only have the statistic from the Central Bank of Vietnam until the end of March. Unfortunately, I haven't accumulated the data here, aggregating the data here. So I haven't seen. I don't have the exact number for the impact. But based on the same trends in last year, we see we continue. I think probably the impact is still like we see a very limited credit expansion to the manufacturing and consumption activities in the first half of the year. Detailed number, I think Ha can provide. You have the number from the banks for this breakdown.
I can just give you my our perspective on this. So I think like interest rate increasing, that would be a negative impact for manufacturing and consumption, demand for credit, if we can show our slide before. Actually, if you look at like the credit driver in 2023 to 2025, when we have the low interest rate environment, the growth driver was mainly real estate developer. And actually, if we exclude that, the average credit growth for other sector, per our estimate, is just around like 10-11% growth per year. For year to date, when we see such a rise, such a surge in interest rate environment, still we saw like the strongest demand coming from real estate. And I just think that the good thing about a good thing about the cap on real estate lending is that it helps to give the credit room for other sector, and so it gives the room for manufacturing and consumption. But at high rate rate environment, then basically the demand from those sectors are also not strong. And the difference in bank lending rate to real estate. So year to date, actually, what we've seen is that the very high lending rate is for mortgage and also for real estate developer. And the borrowing rate for manufacturing actually staying around like 7.5 to 9%. Mortgage rate, like the including the incentive, like fixed rate of the first year or first 2 years, is around 10%, and floating rate 12-14%. So there's a huge difference between the lending rate for each different sector. But again, higher rate is still dampen the credit demand for manufacturing and consumption in general.
Thanks, Anh Long and chị Hà. So the next question is asking about the forex. So please give your opinions about the forecast exchange rates in the next, even for the short runs and in the long time as well, in case of the foreign investor have both a heavy outflow year to date. Thank you, Anh Long.
Thank you for the question. So despite the performance of the good performance of the BND in the first half, only depreciated 0.1%, but currently we still keep our forecast for this year unchanged at the rate at year end, interbank rate at 27,000 Vietnam dong per US dollar. So that equivalent to about 2.6% depreciation of Vietnam dong this year. And also we continue to expect the depreciation of Vietnam dong next year to 27,500. That means another 1.5% depreciation. The reason why we expect that is first we still see the upside risk regarding to the external sector regarding to the new tariff to be imposed by the U.S. government once the Section 1222 expire at later part of this month. And second is because of the high economic growth, so it's likely to be a kind of offsetting in terms of other criteria, including the FX. And given if the higher tariff rate, so it's likely for Vietnam to remain competitive in the external sector. So the VND likely to be allowed for a little of the depreciation. Actually, at 2.5% is not a bad. I think it's not a quite bad performance because if we look at the trend of VND in the last 20 years, actually VND is depreciated each year by about 2.5%. So it's actually in line with the long-term trend. So that is my view on the FX.
Yeah, thank you. And so the next question is for Chị Hà. What is your opinions on when SPV will be able to implement officially the CDR, the new LDR ratio? Thank you.
If you recall, like one of the slide I have in my presentation, I mentioned about like the possibility, and it's actually like likely delay and revise. How to say, when the draft circular like Basel III circular was published, right? And we try to estimate the CDR of the banks that we cover following the new standard. So just to be, briefly here, what is the CDR? CDR is the credit to funding, and the draft circular still put a cap of 85%. However, the definition of credit and funding is different compared with LDR. So for credit definition, it adds other credit exposure beyond loans, including corporate bonds, LCs, and off-balance sheet commitment. And for funding definition, it excludes cross-bank funding from the deposit base, including interbank deposit and also valuable papers held by other banks. So, when we try to calculate the CDR, we saw that most of the banks we cover, they will not, the CDR will be higher than the cap 85%, which means that most banks are not ready. And so, in our view, if the SBV want to apply the new CDR, they need to make revision to make it more practical. Otherwise, banks cannot really grow and cannot support the economy growth. So yeah, and also one more thing is that if you look at the SBV website and you see banks have submit their feedback for the draft, and actually it's kind of like the first time I saw that many opinions or feedbacks from the bankings. We saw like 4 attachments, and each attachment is like more than 100 pages with feedback from all commercial banks. So in general, I think like this draft is good, but it is impractical at the moment, and there will be a lot more revisions needed before it becomes like practical. And I cannot, kind of say anything for sure. Right now, we only think that because there's a lot of revision needed, so it's gonna be a delay. Maybe like toward year end this year or maybe next year.
Yeah, thanks, Chị Hà. So next, I would like to invite Mr. JP from NTSS to ask the question. Thank you.
Hi, Han. Thank you. Dr. Long, Ms. Ha, thanks for the opportunity. I just have one quick question. So, liquidity has been tight for a while, since the fourth quarter last year's, and everyone keeps saying that it's going to get better in the first half this year, right? Well, turn out it's not that better. And now things are tight, and people keep saying that, the interest rate will go down, liquidity will improve. But I just don't see any catalyst that would be positive to increase the breathing room for the policymaker to allow them to bring down the interest rate level, unless the government is willing to slow down or sacrifice some of the growth and push less into the public investment, or push less into the less of the lending into this large conglomerate groups. I just don't see how this is possible. Am I missing something? Just want to hear your thought. Thank you.
So for these questions, anh Long or chị Hà will have us to answer. Thank you.
It's a tough question. You're addressing that why the interest rate is not going down despite the government effort and their promise to come and stabilize the market. I think that is quite a very structured question, and probably I think you already pointing out to all the reasons. For me, if we look at the positive side for improving in terms of the liquidity and the interest rate level is, as I mentioned in my slide. So I hope for a kind of slowing down in terms of the currency circulation outside the banking sector. As I mentioned last year, the currency outside the system rising about 29%. So 29% is even higher than the rate for the credit growth, and much higher than for the deposit growth at around 10%. So that is one thing I have a kind of confidence in that, and also the data from Ms. Ha also showing that momentum. But probably that should not be enough in order to bring the interest rate level down, because given the government they extending the credit for 3 big groups, and the amount is 29 billion, with 85% to be disbursed in the next 3 years. So that means we need to have another kind of capital. The bank, we see from the outstanding and the issuer number in the corporate bond market, the bank is still very dominant, as I mentioned in my slide. And also the interest rate for that is still very high, at about 8% for the bank. Even for the bank had to mobilize the fund in the corporate bond market at about 8%. So that is showing that for the bond market is not a quite a very short-term solution at the moment for coming down the interest rate level. So last thing is regarding to the equity market. So equity raising for the banks or for other corporations is still quite limited compared to the credit providing by the banking sector. So what I hope is after the officer inclusions, there likely might be a spillover effect, and there might be a good highlight for the IPO and so on. So we can see more fund can be mobilized from other sources rather than the banking, and it likely to have for the general interest rate level as well. And the last thing is we see a 90% of confidence level from my point of view is inflation is declining from the peak in the second quarter. And if inflation is still below 4.5% on average this year, so that also likely to have for the real interest rate level to become more sizable for people, and it also might help for stabilizing the interest rate level. I think that's some of my comment. If Ms. Ha have more from the side, you can add to my view. Thank you.
Thanks, JB, for your questions. I think we have discussed this, before. It is. I think like for the banking system liquidity to improve. As I mentioned in the slides, we think like only if there's like the kind of the injection is large enough. Then it will have a bit like more impact to the funding source and so helping stabilize the deposit rate and then gradually can improve and lower the deposit rate. Some other things that we kind of notice is also the active of financial institutions, including banks and security companies, to borrow offshore. So bringing additional funding outside of Vietnam into the system, I think that's also one of the things that help improve liquidity. And also we saw like recently the government also have kind of plan to borrowing offshore. So that would be help to improve the funding base for the economic growth and a bit somewhat like less burden on the deposit, which is very hard to improve and it takes much more time. So yeah, I think I just want to add some observation. But again, as we mentioned, we only expect interest rate to stabilize at this level, and it's gonna take quite a while and more effort from and resources to bring the interest rate level down mildly. Yeah.
Yeah, thanks, chị Hà and Long. So,
sorry, can I ask a follow-up question?
Yeah, sure.
So if the expectation is that the interest rate will stay here, stabilize around here for at least for the second half of this year, have you seen any early sign of stress in terms of the asset quality in the banking sectors? Because if your short-term rate is 8-9%, it's just a matter of time before you see NPL.
Yes, I think I could agree with you on that. And actually, from our conversation with banks in the first half, they already mentioned like there's some signs of asset quality worsening, with retail customers are more vulnerable. And I think it's maybe more so for mortgage for borrowers. So yeah, we seen signs of worsening. And if the interest rates stay at this level for 12 months, 18 months ahead, then yes, we can expect a higher NPLs formation.
Thank you.
Yeah.
Yeah, thanks, chị Hà and JP for asking us. We still have the following of questions for this matter. That isn't there the dangers that leading companies in the stock market become the oligarch rather than the open widely for the others companies? So Long or chị Hà can help us to answer these questions. Because we have more the favorable term for some three group, including Vingroup, Masterise, and Sun Group. So is this the potential risk because it's not equally exposure to others companies in Vietnam right now?
I think in my slide I have mentioned in the MSCI assessment for Vietnam. So that is addressing one of the point. The view is regarding to the floating and regarding to the price discoveries. Especially, we know that some incident regarding to what you mentioned about that. So the answer is maybe if we have this situation continue, that's one of the discussion point that MSCI they will challenging our regulator in order to improve, to not happen like some other case in, for example, like in Indonesia recently.
Yeah, thanks. And so next, I would like to invite Ms. Trang Lê to ask our panelists. It seems that we don't receive the from the Trang Lê. So the next question is, what is your views on the possibility of Vietnam facing additional tariff from the U.S. potentially higher than those imposed versus the competitors from other countries related to the electoral property violation section 301?
Yes, currently Vietnam has been investigating by the U.S. authority on 3 cases. One is on the excessive labor, another is on overcapacity, on forced labor, another on overcapacity, and the last one I mentioned on the IP. So regarding to the next movement is most likely we have to face the 12.5% tariff on the forced labor issue after July. We have not known yet the effective date for that. Regarding to the IP, so the government of Vietnam, they are trying to cooperate with the US side in order to avoid that kind of tariff. So we cannot say that anything about that now, about the chance that we have additional tariff on top of that 12.5% for now.
Yeah, thank you. And so the next question is, to achieve 10% GDP growth, we need a lot of credit and public spending. So do you think this aggressive growth target will create high inflation pressure for Vietnam in the coming years? Thank you.
So for the inflation in Vietnam, we see the impact from the cost put inflation is contributing most to the inflation case precedent in the past Vietnam. For example, with during the COVID-19, we had quite high inflation because of the swine flu fever and pushing the cost for the food and foodstuff basket that account for more than 30% of Vietnam total CPI basket. For other time, like recently, we see the raising in terms of 3 categories: foodstuff, and transportation, and housing and construction materials, due to the rising in terms of the energy price globally, as we know, with the tension in the war between Iran and the US and the closure of the Strait of Hormuz. So regarding to the question, so what I worry most is regarding to the third category is the housing and construction material from the high credit growth for the especially focusing on the infrastructure project. So that likely to make this category to be very sticky in the next 5 years. But with the a kind of the balancing policy from the government, like we already see the government of Vietnam very effectively in contain the inflation during the last 3 months because of the cut in terms of the tax for the gasoline price. Without that, we think inflation in Vietnam to be additional 1 percentage point higher than this current level. So overall, I think inflation is still not the biggest concern from the monetary policy side, but the biggest concern is still the liquidity issue in the banking sector.
Yeah, thanks, Anh Long. I think we move to the last questions for Chị Hà. With the latest monetary easing to support the new investment cycles, how will this affect the bank NIM and how the margin for the lending to those infrastructure projects versus other sectors, as per your observation? Thank you, Chị.
I think overall, I would say like there would be like a downward pressure on NIM with this theme. Actually, even before before all of these recent change in policy, when we look at the banks in 2026, and we kind of expect a flat NIM for most banks, but banks who have high growth potential, likely they will have to face higher funding pressure, and so higher funding cost and impacting the NIM. And because they have high credit quota, so in order to use up all of that quota, they will have to really make a large effort to lend, and that also bring down the yields. So with your questions about like lending to infrastructure, I think like for the state projects, so the component that the banks lend to contractor, doing the state projects, I think for those projects, it will have a quite low yields, perhaps like 7%, even though it is for medium and long-term lending. And that would be majorly kind of impacting the state-owned commercial banks. And regarding like private infrastructure projects, for those funding needs, as we mentioned earlier, we think that banks who have tight connection with the developer will likely, be more involved in lending to those projects. And I think for the private sector, they will, for the private banks, they will need to keep a minimum level of NIM. It very much depending on their funding cost. So why this is not so much like pressure coming from the government, but in order to help to support with the project sponsor, I think the NIM in general will also be compressed somewhat. Yeah, so overall infrastructure, whether it is like public project, a state project, or private projects, I think it will impacting negatively to the NIM of banks.
Thanks, Chiha, for your answers. And dear investors and clients, after 1.5 hours of rich discussion, we have come to an end of our sections. We trust that today's insights that give you a much clearer pictures of Vietnam macro trajectory and how the fiscal and monetary mechanism are designed to achieve 10% GDP growth target, not only for this year, but also setting the sustainable foundations in the coming next 5 years macro cycles. And on behalf of HSC, we highly appreciate your time and your continued partnership. Thanks for joining our call today. We look forward to seeing you on very soon in our upcoming discussions and event. Thanks Anh Long and chị Hà for your very comprehensive discussions and sharing your views with the latest updates from Vietnam Pictures. Have a wonderful afternoon ahead, everyone. Thanks a lot for your time.
Thank you. Thank you all. Goodbye.
Thank you and bye-bye.